Hi, everybody. Welcome to today's webinar. Thanks so much for being with us. Today, we will be speaking about fundamentals of financial documents. My name is Meredith Medlin, and I'm so glad that you've joined us today. During this hectic time for small business, Accion Opportunity Fund is proud to support entrepreneurs through opportunities just like this webinar. As many of you know, Accion Opportunity Fund is a national nonprofit organization that provides affordable working capital to small business owners across the country. But we also focus on business advising and education to ensure that entrepreneurs have all the resources they need to reach their goals. Today's webinar will help you learn the most important foundations to a financially successful business. Financial management can be really intimidating, but our goal is to demystify processes and documents that you need to make sure your business is set up for success. After today's discussion, you'll be in a stronger position to take control of your finances and really truly understand how your business is doing. Before we begin today's discussion, I just want to quickly go over a couple of housekeeping items with you. First, you should have received a link in your reminder email yesterday that provides you with a worksheet to go with today's webinar. That worksheet allows you to test your own knowledge and use what you've learned today to apply these concepts in your business. If you did not receive the worksheet link yesterday, don't worry about it. I will put the link in the chat box for you right now so you can click it and follow along. You should be able to view our presentation through the Zoom webinar tools window on your desktop if you've joined us by computer. I highly recommend following along with those visuals because they're very helpful, especially for today's topic. Next, you will see a chat function in the Zoom window's black toolbar. I encourage you to locate that chat button and type in any questions you have throughout the presentation. We will pause a couple of times during the presentation to take some questions, so feel free to type in those questions as they come to you so you don't forget them as we go along. We'll make sure to cover as many questions as possible. We really want to hear from you and make this a conversation that brings a lot of value to you and your business. Next, we are recording today's webinar, and this is super useful to you because I will send an email containing a link to the recording shortly after the webinar concludes today, so you can refer back to this information at a later time. Lastly, when the webinar is over, you'll be prompted to complete a short survey, very quick 2-minute survey, and we really appreciate it if you'll take some time to give us your feedback. We really value that feedback. Now, I am pleased to introduce my colleague, Louise Ramos, an expert small business coach with years of experience assisting entrepreneurs with their financial and business plans. Thanks so much for being with us today, Louise.
Yeah, my pleasure, Meredith, honestly. So, hello, everyone. My name is Louise Ramos. I am the Director of Business Advising here at Accion Opportunity Fund. Just a little bit of background about myself. So, I have been working within the CDFI space, helping entrepreneurs like yourselves for the past 8 years now. Time goes pretty quickly. But throughout that experience that I've gotten to meet so many wonderful entrepreneurs, and really finding different ways to kind of assist them and really educate them and provide resources to continue helping scale up or start their own businesses. So I'd say let's keep going. And so for today's class, we have a couple of objectives. So we're going to be learning a little bit more about really kind of the importance of having good bookkeeping practices and how it can help you and why it matters for your business. Alongside with that, we'll talk a little bit more regarding financial fundamentals, really understanding the key components, at least as financial documents pertaining to your businesses. So we're going to talk a little bit about in detail regarding the profit and loss statement, a balance sheet, and a cash flow statement. And if you don't know what that is currently, that's okay. We're going to be talking about those in detail. And after this class as well, we'll be able to provide additional resources, and you'll be able to also get in touch with me if you have additional questions as well. And then finally, we'll wrap up and have a couple of question and answers, a little bit of a Q&A, just to see if you guys have any questions, make sure that everything, really got in there and stuck in there, right? So with that, let's go ahead and get started. So the importance of good bookkeeping practices. So why does it matter? Just as a quick reminder, this is an introductory course to financial fundamentals. So we're not going to be going into too crazy in detail regarding a lot of these topics. What this class is really kind of aiming for is to help you understand, really get a foundational level understanding, so that you can at least start, working on these things as it pertains to your own business, so you can continue scaling off of that knowledge that you gained today. So one of the biggest things that I always seem to encounter when I'm working with an individual, or I'm coaching someone in one of my one-on-one sessions with someone, is I always ask them this very important question, right? As they're either looking for capital, or they're trying to get a lease for their business, or they're trying to expand, or they're trying to do something. And I always ask that business owner, okay, well, I'm glad that you're here. I'm glad that you're interested in applying for a loan, or whatever that may be, or getting a lease. So tell me, did you make any money last month, right? How much money did you make? Or, you know what, do you know exactly how much profit you made last year, last month, right? Or the previous week? And it's one of these questions that I've encountered so many times, where an entrepreneur or a business owner doesn't really understand that, right? Um, I've noticed that a lot of the times, whenever someone is running their own business, they're so stuck working in the business that they really can't pull themselves out of their business to work on it, right? So a lot of the times, a lot of entrepreneurs, and maybe you can relate to this, is that I'm just so busy just trying to get the day-to-day done. I'm just so busy trying to make that next sale, pay the next month's bills, pay my employees, whatever that may be, right? So there really isn't a lot of focus as far as working on the business. So one of the biggest things, as far as from an owner's perspective, that you really have to develop, is really pulling yourself out from your business so that you can start really working on it, right? And what I've noticed is that entrepreneurs that eventually get this skill set to be able to work on their business are able to scale their business and build up that business a lot more quickly. And one of the best ways to do that is through sound bookkeeping practices that'll really give you all the information that you need to really get a solid understanding of where your business is right now, where it was in the past, and where you're planning on taking that business in the near future. So what can an organized financial management system do for you? So just having your bookkeeping in order does so much for you, right? So one of the things that it does is that it frees up your time, and it'll help reduce your stress. Um, it helps your customers pay quicker, right? So there are a lot of entrepreneurs out there that offer credit terms to their clients and say, hey, you know what? Maybe you're a small caterer, right? And you get a contract from Facebook, and they want you to cater a certain event. And you know what? A lot of times, whenever you're doing these kind of contracting jobs, a lot of bigger organizations and corporations, they tend to pay out in a net 30, net 60, and a net 90. And what that really means is that they're going to pay you 30 days, 60 days, or even 90 days later after you perform their services. And if you're not up to your book, if you're not up with your books, then a lot of times 30 days might pass and you forget about it. 60 days might pass and you might forget about it. So having an organized financial management system really tells you, hey, it's been 30 days, I need to get paid, right? Or it's been 60 days, I need to get paid. Why haven't they paid? And it's a good way to keep on top of a lot of things regarding to your business. Same thing with vendors, right? Ensuring that, you know what, if your supplier gave you whatever it may be for you to keep running your business and you haven't paid them on time, it's a good way to ensure that you have that good relationship with those vendors as well. It also helps with easy financial reporting. So being able to do your taxes, right? By having all this information at hand, whenever it's tax season, you're not having to work with your bookkeeper. And I've seen it time and time again where a small business owner or an entrepreneur just brings that bookkeeper like an entire notebook full of just receipts and paperwork and just so much stuff, right? And what ends up happening is that, a bookkeeper and a CPA's time is really valuable. So what ends up happening is that becomes an expense, as they're charging you for the hour in many cases to do these things for you as well. So you're saving money in that aspect as well. Also, it helps inform strategic decisions for your business. So if it'll really help you understand where you're growing and where you may not be growing, right? If you implement a new product, is it selling well? And is it not, right? So it really helps you have a better decision-making practices as you're thinking about, offering new services, offering new products, even cutting services or products that may not have worked as anticipated. And finally, having really organized financials really helps you attract lenders and investors, right? One of the first things that happens whenever I'm working with someone that is looking for financing, or when I'm working with investors as well, helping a client pitch to them, is what really impresses a lender or an investor is really when you can say, hey, last month I made X number of dollars. I spent X number of dollars in my cost to keep my business running. I know that within the next 6 months I can make this much money, and this is what I need this much money for me to double that, triple that, whatever it might be. So it really helps you sound really professional in front of these lenders and investors. So it's super useful to have good financial management systems in place. So next, we're going to be talking a little bit more about the types of financial statements that currently exist. For this webinar, we're going to be focusing primarily on interim financials, which is what you see on the far left in this presentation. So interim financials are internally prepared financials that are prepared by the business owner, right? They're not older than 90 days. And what they really do is it's kind of you preparing just, these are my financials for the current year, the current month, and I created these myself, right? They can be a little informal, right? But that's okay, right? As long as you have an idea as far as what you're doing with your own business. Next, we have compiled, reviewed, and audited financials, and these are done by your CPA or a really good bookkeeper as well. And this is more of financials that are created professionally, right? By a professional who you pay and you get these things taken care of. And finally, we have tax returns. So at the end of every calendar year or fiscal year, depending on what you're on, your CPA or if you file your taxes yourself, you'll submit this this form. It's either a Schedule C, an 1120S, whatever it may be, to the IRS, and they really tell you kind of they tell you how much money you owe in taxes, etc. And lenders use all these three things, and investors use all these three things to really gauge the health of your business. So one of the main things as you're getting started in formalizing your financials is you have to choose an accounting system. And what that really means is you have to choose a method in which you kind of start tracking of all of the little exchanges, interactions with your sales, with your clients, etc., and even your suppliers. So there's two ways of doing this. So what I see most entrepreneurs choose is cash accounting. And what that really means is that you only record something, you only record these finances or in your books when you make it. So cash accounting is when you get cash or when you pay cash out, right? It's a very easy and informal system. And it really just tells you when cash is moving between your business into or out of the business, right? And next, we also have accrual accounting. So a lot of lenders and investors prefer the accrual accounting system because it really keeps tabs on everything. So even if you haven't gotten the cash for something, as long as you made a deal or if you set up a contract and delivered services to someone with a promise of getting paid or paying someone else, then you record that immediately. So what accrual accounting does is it just gives you greater clarity as far as what money is still owed to you and what money you still owe to someone else. And that's primarily the only difference between cash accounting and accrual accounting. You can't have both. So I've seen people that try to do both. So don't do that. So it's either just track cash as it's moving in and out of your business, or if you want to track everything, is tracking as soon as you make a deal with someone with the promise to pay or getting paid. And that's really the main difference. So financial fundamentals. So the key financial statements that you should be familiar with. So there are, in this webinar, we're going to be talking about the three, in my opinion, the most important financial documents that you should be familiar with. So first, we have what we call the profit and loss statement. This is also called an income statement. And what it really does is it tracks and it represents the activity of your company over a period of time. Usually that tends to be a calendar year. So it'll record every single dollar that has come into your business from January 1st all the way to the end of the year, right? It tracks every expense that you've made. It tracks every rent payment that you've made for your commercial lease, every single dollar that has gone out of your business, and every single dollar that has gone into your business. And a good way to look at it is it's kind of like your journey in your business within a year. So I put a little road there just because it tends to be kind of like your journey within your business, right? So what a profit and loss tells us as a business owner is whether you made money or you lost money within a year, right? And this is one of the most important financial statements that a lender or an investor will look at, and that you should definitely get to know, as it really tells you if you're being successful or not, right? Next, we have what we call a balance sheet. And what a balance sheet really is if the profit and loss is your journey, right? It's the whole journey that you took. A balance sheet is more of a snapshot in time, right? So I imagine it more of like taking a picture of your business, right? So how did my business look like maybe today, right? So for today, what does my business look like? And what that really means is how much cash do I have? How much money do I owe currently on different things? So it's really more of like, this is the health of my business as of today, right? So it's a picture of that day. And finally, we have what we call a cash flow statement, or just cash flow. And it really represents the change in cash accounts over a period of time. So the best way to understand cash flow is to really understand, it's kind of like looking at your bank statement, right? It tells you, it's kind of like, and I put a couple of different glasses in here filled with different amounts of water, because it really tells you what your glass or your checking account looked like for that business over a period of time, right? So what was my cash flow in January? How much money did I have in my account? How much money left my account? And going into February, at the end of February, do I have more money than I did in January, or do I have less money in January or in February than I did in January? So it's really an understanding as far as how much cash do I currently have in my business to really pay all of my bills, pay my employees, and really get an understanding of, is that money going up or is it going down? So first, we're going to look at the profit and loss statement. So as I mentioned earlier, the P&L, also called an income statement, illustrates a company's sales and expenses and profit over a period of time. The best way to understand a P&L is to compare it to the journey that you take with all the ups and downs within your business. So it kind of like culminates everything that your business has gone through in a year. All the money that you have made, if it's, how your business went up and down, the seasonality of all these things, it's all represented within a profit and loss statement. So a profit and loss statement has several components. So the first thing is that you'll see is that it has at the very top is we have all of our revenues, right? And really what that really means is how much did my business sell, right, within a year, right? What was the total sales that I had? And after that, you have what we call COGS, or cost of goods sold. In order for me to make those sales, what did it cost me to make those sales? So these are what we also call direct costs. So direct costs are anything that really really kind of like, what does it take me to make those sales? So for example, if you're a food business, right, or a restaurant or a caterer, that'll be all of your ingredients, right? All of the things that you need to make those sales. If I'm selling tacos, it'll be the tortillas, the meat, all these different things to make those sales. It could even be the labor that I'm paying someone to make that for me or cook that for me as well. So once you subtract your sales from your cost of goods, we get what's called your gross profit. And your gross profit is really, this is how much money I have made so far before I pay for all of my other expenses, right? My operating expenses. And your operating expenses are really, what does it take for me to keep my business up and running, right? So for me to be in business, so even if I don't make a single sale today, it still costs me to be in business, right? So there are things that I can't ignore even if I didn't make a sale. So things that you can ignore would be things like your rent payment, if you have a lease. It'll be your insurance costs, right? If you have insurance for your business, as you definitely should. Anything that you have to make a monthly payment on, it could be your utilities for your business. It could be the cell phone bill for the business. It could be internet expenses, etc. So these are monthly expenses that are in no way related for you, no way related to you making a sale, right? But are still needed for you to operate that business, right? So once we subtract these expenses from your gross profit, you eventually get your net profit. Here, I also included interest and other expenses, but for the sake of this webinar, I don't want to overcomplicate things, but interest would be if you owe interest or these kind of expenses like a loan to a lender or anything like that, that would be calculated in here as well. So for now, we're not going to worry about that. We're only going to worry about like the things that it takes for you to be in business. And once you subtract all of these costs from your gross profit, we get your net profit. And your net profit is really a summary of, it really tells you, did I make money at the end of the day or not, right? So a lot of times I'll ask a business owner, did you make money last year? Yes or no, right? What was your net profit? How much money did you make? And if you don't know this number, then a lot of times that a lender and investor will be, you know what? I don't know if you're sophisticated enough or formal enough to apply for a loan or for me to invest in your business, right? So it really kind of really tells you how much knowledge and how much experience that business owner has if they're able to kind of like tell you all of these things, right? Like I can tell you like what my gross profit was, I can tell you what my cost of goods sold was, etc. So here we have a quick example. Here's Blake's brake repair shop. And I ended up putting 2 years here. So these are just samples of what an income statement would look like, right? It tells you kind of how much Blake made in total sales at the very top. And at the very bottom, as we're like reducing or taking away from these line items, it tells you what that net income was. So if we compare net profit between 2018 and 2019, we see that his net profit is actually increasing, which is actually a really good thing. So I won't stay too long on this slide, but we're going to be using this as we're calculating several important calculations that you should know as you're kind of scaling up your business and really understanding your business. One other main thing that compiling a profit and loss for your business does is that it really helps you with your taxes as well at the end of the year. What I included here is what we call a Schedule C. If you are a sole proprietor or an LLC sole proprietor, this is the form that your accountant or your bookkeeper will prepare for you as you're giving them all of the receipts, all that information that they need in order for them to do their job, right? So what this does is they're compiling this profit and loss, just as we saw in Blake's Repair Shop, except this is what they're sending to the IRS, sending exactly how much money your business made or lost, and how much money you have to pay to the IRS as far as federal taxes, right? So this is the exact same thing. And I wanted to highlight this because what ends up happening is as you feel more comfortable with your own finances, this is something that you could easily prepare yourself as well. I would still get a bookkeeper and accountant to just kind of like proof everything just to make sure that you did everything correctly. But what's really nice about knowing this information is that you can save a lot of time and money by having this prepared so that they take less time to kind of like do everything from scratch, which is really nice. So yeah. So as you're preparing your profit and loss statement, there are 3 important calculations that you should know. So one is what we call a sales growth as a percentage calculation. Second is the net income calculation. And third is the net profit margin. And I'll explain what all of that means. It sounds very complicated, right? But it's not. But I'll explain what every single one of these things is and why it's important for you as a business owner to know. So first we have sales growth, the sales growth calculation. So the sales growth formula indicates whether sales increased or decreased over a period of time. This can help measure growth of new initiatives and products. So if we use Blake's Repair Shop as an example, so what we end up doing is we end up getting the recent period sales. So in this example, we're using Blake's 2019 total sales, and we're subtracting his 2018 sales. And then we're dividing it by the previous sales, right? So if we do this calculation, and then we multiply it by 100, it gives us a percentage. So why it's important to know this is because it really tells you what was your sales growth over a period of time. You could do this over a month-to-month period if you wanted to. You could do this over a yearly period if you wanted to. I tend to see this being done usually in a quarterly or a yearly basis. And what this really does is it helps measure kind of like the success or the growth of your business if you do something different within that period of time. So in this example, let's say that Blake said, you know what, 2018 was doing pretty good, but my friend told me that if I start advertising a certain way on Facebook or Twitter, that it's gonna give me better sales. So this is a tool that a lot of business owners tend to use in order to gauge the performance or the success of a new initiative, right? It could be a new product. It could be a new marketing initiative. So if you do something new and you're trying to measure if it's successful or not, you could use the sales growth calculation to understand how successful that 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 thing that you did was. So in this example, let's say that Blake used a new marketing, let's say they started marketing on Facebook or doing something new, and they really want to gauge how have my sales, changed over time. So by doing, let's say, Facebook marketing, their sales grew 10.5%. So that means that compared to 2018, 2019, he got 10% more sales because of this new initiative. Let's say that he did nothing else new. The only thing that he did differently was he used this new Facebook initiative, right? Then what you could get, or what you could attain from this information was that by using this new thing or this new product or this new marketing initiative, his business grew 10%. And that's great to know, right? So this is also really good to know. It might not be 10.5%. It could also be negative, right? So what you want to know as a business owner is, how can I measure the performance of something new that I do? And really, that's what we use a sales growth calculation for, right? So that's one of them. Hopefully it's not too complicated, but I'm trying to break it down as much as possible. Next is your net income calculation. And I actually explained this a little bit earlier, but it's really an understanding of really understanding what your net profit was at the end of the year. So what every business owner should get, at least at the end of this webinar, is they should be able to go, you guys should be able to go into your own books and be able to prepare this for yourselves. And more importantly, what you want to start doing from now on and into the near future is you really want to understand what your net profit is at the end of every single month, right? So from January to February, you really want to start understanding whether you're making money or you're losing money. Because as a business owner, what you really want to start doing is you want to start tracking really closely how things are changing over a given period of time. Because one of the things that a lot of business owners, as I mentioned, tend to do is they get really stuck in their business. And by being able to pull yourself out and say, oh my goodness, you know what, last month I made a profit, but this month I didn't. And you know what, going into next month, I'm not making a profit again. So it really helps a business owner understand, hey, something is happening here that I am not seeing yet. And I need to understand why I'm not making money. Or even if you are making money, you know what, I'm making money and I'm making even more money. Why is that? And by looking into your like income statement and looking at your net profit, it really helps you understand what are the line items. Maybe your rent increased, right? Maybe your ingredients or your supplies are going up in price, and you have to adjust your prices, right? It really helps you understand how your ever-changing business is really adapting, right? And how that's affecting your bottom line or your net profit in this case. And this is how you calculate it. And finally, we have what we call the net profit margin. And what the net profit margin does, it's a percentage. It really indicates the percentage of profit for every dollar of revenue. And I really love using this calculation when I'm working with a new client that has an existing business, because we can really understand the power of every single dollar that the person is using in their business. So what the net profit margin tells us is it really tells you for every dollar that I'm putting into my business, right? Or every dollar that's in my business, how much of that dollar is profit for me? So the way you calculate this is you get your net profit at the end of the year, and you divide it by your gross sales, or your revenue in this case, which is 105,000 if we use Blake's example, and you multiply it by 100, and you get a percentage. And what that percentage tells us is how much of every dollar in sales that we're making that is just pure profit. So if we look at Blake's repair shop for 2019, every time he sold something, right, or sold a service, sold an item, whatever it may be, every dollar that he sold, for every dollar, he was making 23 cents, 23.8 cents in profit for every dollar. So as a business owner, what you're trying to do is you're trying to maximize as much as possible how much money is profit for your business, right? And the higher that number is, the more money your business is going to be making off of that dollar of sales. And the smaller it is, you really have to start like adjusting. So if it's under 5%, you really want to understand why it's under 5%, right? And if there's things that you can do into your business to start becoming more profitable. And the only ways to do those things is either by charging more money for products or services, or by reducing expenses, whether it's getting a cheaper lease, reducing insurance expenses, finding cheaper suppliers for items, stuff like that. So it's a really good calculation to really understand how profitable your business is whenever you make a sale, right? So with that, that is the profit and loss statement. Hopefully it's not too complicated, and I think we can take a couple of questions now.
Yes. Thank you so much, Louise. I feel like I've learned so much just in the past 10 minutes. But I want to get to a few questions. We have 4 or 5 already in the chat, which is so exciting. Thank you guys so much for engaging. And we definitely want to answer a couple of these.
Of course.
And some of them are very similar. It makes so much sense. The small business owner mentality is so similar. So we can kind of group a couple of them together. But
cool.
So Teresa and Ellie are wanting to know sort of similar things about where certain costs would go within the profit and loss statement. And so in the example you shared about Blake's brake repair, when you were calculating the sales growth, if, for instance, the business would really benefit from that marketing initiative and grow the sales, where would you put whatever the marketing initiative cost? Like, how do you, if they had to hire a consultant or hire a marketing firm or pay for Facebook ad, any costs associated with the new initiative, where would those be reflected on the P&L?
Of course. So I'll go over here. So this is the best way to look at it. So the best way to look at it, so in a profit and loss statement, you will have 2 types of expenses. One is what we call direct expenses, as I mentioned earlier. And direct expenses are everything that's tied to you making a sale. And what that really means is everything that goes into you making that sale, right? It could be ingredients. It could be the direct labor used to either provide that service or help create that product, right? So these are all of the things that are related to the product or the service. And outside of that, we have what we call operating expenses. And if, for example, you were to do a new marketing initiative, then if you look into this, sample profit and loss statement, that the cost of that marketing initiative would go under, in this tab, you see advertising. So anything that is not related not related to you making a sale, right? Not directly tied to the cost of a product or a service, then that would be an operating expense.
Got it. And that's actually a great place to keep this slide for Ellie's question, which is where do you include your own salary? And so I can see salaries listed there. So that's what is a cost to keep the business open, but not a direct cost of the product or service you sell, right?
Right, correct.
Perfect.
So this is actually where it gets a little tricky, right? And I'm not going to overcomplicate things. Um, it really depends as a business owner if you are considered an employee of the business. So as a business owner, you have the option to either be an employee or not. So a lot of business owners tend to not do that. And so what you would see is in their profit and loss statement, you wouldn't actually include your salary in this if you are not an employee. So the way that it works out for a lot of business owners, especially for like early businesses, is that at the end of the year, whatever net profit is made or lost, right? What you end up seeing is a lot of business owners tend to get their salary from the net profit. And that's usually how a lot of people tend to manage their businesses if they're not considered an employee. If you are considered an employee, and let's say that you're paying payroll taxes on yourself and all these things, and this is like it leads to another bigger discussion whether you should be an employee of your business or not, right? And that's something that we can definitely present on in the future if you guys are interested. Um, so if you are considered an employee of the business, then you would be under an operating expense. So we would add a category here that would be called owner's compensation or management, something like that. And that tab would kind of like record how much money you are paying for yourself or any other manager, depending on how you want to lump that in there as well. Usually when you're putting operating expenses, that's usually how you would calculate that. Not to overcomplicate things, but it really depends if you categorize yourself as an employee of your own business or not. And if you are, kind of like the only way to kind of like really identify or categorize that you are an employee is if you're also paying payroll taxes on yours for your own labor going into the business as well.
Okay. That's a really helpful distinction. Thank you.
Mm-hmm.
All right, we've got so many questions coming in, which I love and I'm so excited for. But we'll take a couple minutes to do just a couple more, and then we'll move on to balance sheet, and we'll come back for more
Okay.
questions later. So, on the sales growth calculation, Latanya's wondering if you implement multiple changes at once, is there a way to discern this percentage of the growth is associated with this change and then another percentage of the growth with another change, or should you try to take them one at a time so that you can differentiate?
So usually that's kind of like the only flaw with sales growth calculation is that since it really encompasses your business as a whole, there's no real way to kind of like separate different things into it as well. But the best way to kind of really identify, you actually can kind of like mitigate that in many aspects is if you do the sales growth calculations from like in a smaller gap of time. That's usually the best way to do that.
Okay.
And so instead of doing like a yearly analysis of your sales growth, so instead of comparing like 2019 versus 2018, let's say that you do a new marketing initiative and you want to and you want to see if it was successful or not, right? So let's say you could probably compare a month or 2 months instead. So you could just do the sales instead of plugging in here like your yearly sales, you can do monthly sales as well. And that's really a way to kind of like just shorten that time frame and really get a better understanding of like, you know what, I implemented this new marketing, whatever it may be, or this new product, and I really want to understand within like the first 3 months if it's how successful it is or how if it's not successful at all, right?
Mhm.
So usually the way to mitigate that is to just kind of like shorten that time frame.
That makes sense. Okay. And then the last question that we'll take here, just in this section, we'll come back for more second questions later, guys. Don't panic. Is around the net profit margin calculation. Just to clarify, so when you're calculating your net profit, in this example, the 23.8%, that essentially means that for every dollar of revenue,
Correct.
the business is generating a profit of 23.8 cents.
Correct.
Okay.
So that means that for every dollar that's going into your business as far as sales, 23 cents off of that dollar, or I guess 24 cents if you round up, is pure profit.
Got it. So then that's the remainder goes back into your covering your costs and everything
Covering
else for
all
the
of your
business.
costs, correct.
But the
Yeah,
business makes those 23 cents. And then, so as the business owner, depending on if you are an employee officially or not, decides whether you personally are making that 23 cents.
correct. Yeah. So at the end of the year, you can say, you know what, I'm going to keep that for myself because that's my share,
right,
or I'm putting it back into the business. You can choose whatever, you choose, essentially.
Okay. Thank you so much. And thank you
Not a
guys for all
problem.
these questions. We're going to get to as many of them as possible, and we can provide additional materials after the fact as well. So let's move on to balance sheet.
All right. So the balance sheet, really illustrates what assets a company owns and what liabilities a company owes and what equity has been invested at a specific point in time. So as I mentioned earlier, is that a balance sheet is really a picture. It really tells you how your business looked like at a certain period of time. So it's kind of like a photograph, and it kind of it just tells you, you know what, on this day in, let's say, you could even say like in 2019, in June 10th, my business looked like this. I had this much money in my bank account. I had this much money coming in. I owed my vendors X number of dollars. It really just tells you what your business looked like for that period of time. So the best way to look at a balance sheet is by doing it. It really is three different things. So the reason it's called a balance sheet is that it always has to balance out. And what that really means is that assets will always equal your liabilities plus your equity. Assets are really anything that brings value to your business, right? It's the cash in your business. It is the value of your equipment. It is basically everything that brings value to your business, tangible or intangible. And I'll talk about that a little bit further. Liabilities are everything that your business owes money on, or it's anything that's taking away value from your business. And then equity really is kind of like the value that your business has, right? It's all of the money that you personally have invested into your business. It's the value of the stock, if you have stock, and it is any retained earnings or any money that you put into your business as your business is generating money. So if we look at the net profit at the end of a year, you could either take that money out for yourself or you could put it back into your business, and that would be equity into your business. So assets are anything of value. It could be both tangible and intangible that the business owns. An asset could be either a current liability or a current asset or a long-term asset. A current asset is anything that you could turn into cash within a year. Examples will be your inventory, your accounts receivable. Accounts receivable, just to kind of give additional clarity, is any money that is owed to your business. So if you offer your clients credit, or if you took a contract, it's any money that is promised to your business because of a sale that you haven't collected on yet. Security deposits, cash. It's basically anything that is essentially cash in your business. And then long-term assets are assets that are not easily converted to cash, but instead are used to produce sales. So these are your equipment. This is your furniture and fixtures. It's the improvements that you made in your lease or your commercial real estate. It's real estate, it's land, and intangibles. It's really anything that brings value to your business, but it's a lot harder to turn into cash, right? You can't go from one day to the next and turn your equipment into cash for its full value in many cases. So that's really kind of like the main distinction between these two things. Liabilities are debt or other financial obligations that the company owes to a third party. There are two types of liabilities as well, current and long-term. Current liabilities are anything that you expect to pay within a calendar year or within a year. These could be accounts payable. For additional clarity, accounts payable is anything that your business owes money to, whether it's your suppliers, vendors, creditors, whatever that may be. It's the balances on your credit cards, balances on your lines of credit. It could be your income tax payables. So it's anything that you know that within a year I have to pay these things. And then long-term liabilities are things that you owe money on, but you're generally going to take longer than a year to kind of like pay all these things back. These are equipment loans, mortgages, and other long-term debts. And finally, we have equity. And equity is what we consider the book value of a company. It is what you have, is what you as an entrepreneur have added as value into the business. It is all of the net profit that you retain in the business. It's all of the money that you personally have invested into your own business as you've grown that business over time. And there are three ways to kind of really categorize that. First, you have stock. A lot of businesses don't have that. So if you don't have that, don't worry. But it's the value assigned to ownership in a company. Paid-in capital is the amount of funds you personally invested as an owner or a shareholder in the business, right? So as you're starting your own business, this is the money that you personally invested to get your business off the ground, right? You could have sunk in $10,000 to buy a food truck. That would be paid in capital. And finally, we have retained earnings. So this is the accumulated net income that you have put into the business or you have retained in the business. So let's say that at the end of a year, your business made $23,000. And as an owner, you have the option of either getting a distribution. What a distribution really means is if you decide to take some of that money as, you know what, I did great. I owe myself a little bit of something. I'm going to take some money off of that net income because, you know what, I earned it, right? And you can do that. Or you could you could say, hey, you know what, I'm going to reinvest this money into my business because I want to buy more equipment. I want to do X, Y, and Z, whatever that may be. So that money that your business profited at the end of every year is retained earnings, right? And this is primarily the way that your balance sheet will be connected to your income statement or your profit and loss statement every year, right? As you're working on these things. So here is a sample balance sheet, right? And as I mentioned earlier, if you look at the very bottom of these two things, you'll see that it's called a balance sheet because it has to balance. You know, anytime that you create a balance sheet, it has to equal perfectly to each other. So for example, total assets will always equal total liabilities and equity. So if you look in this example, you'll see that total assets are $171,000 and 171,900, and total liabilities and owner's equities are 171,900 as well. So the best way to explain a balance sheet is really kind of understanding that for every dollar that you're putting into the business, every single asset will either be categorized as a liability or just additional equity for the business. So let's say, and the best way to explain this, because this can be complicated to some entrepreneurs, is the best way to get it to understand it is, let's say that I take a loan out for my business. Say I take a $10,000 loan for my business, and I'm using this $10,000 to buy equipment. Let's say that there's this really nice stove that I really want to get for my commercial kitchen, and this is going to really help me prepare more product, right? So this $10,000 will be actually reflected in your balance sheet on both sides. So with the $10,000 that you're using to get this equipment, you will buy a long-term asset, right? This long-term asset, for example, we'll call it equipment. And let's say that I buy this equipment at $10,000. So this stove is worth $10,000. So I have a $10,000 long-term asset that is categorized equipment that is worth 10K. But obviously I had to take out a loan for that in order to kind of get that equipment, right? So at the same time, I don't completely own that piece of equipment because I still owe that money to someone else. So that same $10,000, you would have to put it as a long-term liability on the liability side. So under long-term liabilities, I would put $10,000, right? So in essence, what a balance sheet does, it helps balance your books, and it tells you, you know what, I have $10,000 in assets from the equipment that I bought, but I also have a $10,000 liability because I had to take out a loan to get this, right? So it balances out, and that's why it's called a balance sheet, because it helps really kind of track everything, that every single penny is really attached to something, right? And let's say that maybe you didn't take out a loan, right? Let's say that instead of getting a bank loan, you get this, you decide to buy this equipment with your own personal funds, right? Let's say that you're going to invest in your own business and put that $10,000 in equipment yourself. So on the asset side, it would be the exact same thing. It would be a long-term asset worth $10,000 on the equipment side. But instead of a liability, this would be called paid-in capital, right? So me as an equity, I'm adding more equity to my business. I'm adding more value to my business. So I'm increasing the value of my business by $10,000. So under equity, I would put this personal investment that I made into my business. So regardless of what you do, your balance sheet would always balance out regardless of what's happening, right? And that's really what a balance sheet does. So for the balance sheet, there are two critical calculations that we want to explore. One is what we call a cash ratio, and two is what we call a net worth, or equity versus debt. So the cash ratio, or a liquidity ratio, it's used to measure a company's ability to meet short-term liabilities. So the best way that we can express this is if we get all of our current liabilities in our cash, and we divide it by the money that we currently owe to someone within a year, we'll get a cash ratio. So in Paul's repair shop example, he has about $32,000 and that he has in cash right now, or money that is owed to him currently. And we're dividing that by the $50,000 that he currently owes to someone else. It could be vendors, whatever, loans, loan payments, credit card payments, whatever that may be. And we multiply it by 100. And what ends up happening is we get a ratio. In this case, we get 0.65. And what this ratio really tells us is, do we have enough money currently as a business, as of right now, within this snapshot, within this picture? Can we pay all of our debts as a business, right? This ratio can go below 1 or above 1. If it's at 1, that means that you have a perfect balance. And what that really means is that I have enough cash to pay all of basically anything that I owe money on right now currently, right? If it's under 1, that means that I may need working capital. It may need that I don't have enough money currently to cover all of my costs. Or it could also mean that, you know what, I have, I'm using credit to grow my business, and I'm expecting to get more money later on as well, right? And the same thing, if that number is over 1, it tells us that I currently have more money than I do current liabilities or current debt or things that I owe money on right now. So I'm very profitable, and I have a lot of money or a lot of cash in my accounts currently to cover these expenses. That sounds very good as well, but it could also mean that you're being inefficient with your cash. That means that you have too much cash in your accounts, and maybe you're not using that cash effectively. It could mean that you're not putting more of that money to increase your business or scale up your business more, either by getting additional interest from that, paying off a loan, or even reinvesting in the business in new products or services, right? And that's really what a cash ratio does. And next we have net worth and equity. And really what net worth equity does, it's your book value of your business. So if you get all of your assets and you subtract your liability, you get your net worth, or what we call your book value of your business. So in this example, we see that if you subtract all of your assets by your liabilities, you get your equity. And if you're thinking about selling your business, that's at the very minimum, on a book value, my business is worth $21,000 or $22,000 if you round up. So I could, at the very minimum, sell my business for this much money if I wanted to sell it. Obviously, this doesn't take into account other tangibles like clientele, your marketing. It doesn't take the power of your brand, all of these different things. But at the very minimum, I could sell my business for this much money, right? And that's really what the book value or the net worth really tells us from a balance sheet perspective. So if I look at my business today, my book value of my business is this much. And this is a number that'll always fluctuate over time. Every single day it'll be different. But you can calculate that, which is really nice. So questions. So,
All right.
yeah.
Any questions that you guys have about balance sheet? We can also go back. I have a few questions that we didn't get to related to profit and loss, or things that are sort of more general that come across both topics. So let's see. Oh, we had a really good question from Pamela about how
Uh-huh.
this would factor, how both of these, the P&L and the balance sheet,
Of course.
would factor into putting together a business plan potentially for trying to get your first small business loan. I
Excellent.
think that's a great question
That's a
for
great
you,
question.
Louise, definitely to answer.
Yeah, no, honestly, especially if you're looking for your first business loan, it is so imperative that you can prepare these two things for your own business. Because what's going to happen is that a lot of times as you're approaching a lender, you want to sound very prepared as a business owner whenever you're talking to someone. So what preparing a profit and loss statement and a balance sheet does, it really tells you about the health and the state of your business. And it really tells you if how profitable and how successful you are in managing that business as well. So a lot of times, and why it's important, especially as you're preparing a business plan, is that a lot of times, and I've seen it count time and time again, is sometimes I'll sit in with a lender and a client, and just trying to get a better understanding of that client's needs as I prepare to work with them. So a lot of times, a lender will talk to an entrepreneur or small business owner, and they'll say, "Okay, thanks for coming into the office. I know that you're interested in getting additional resources or financing. Tell me about what you need and why you need that, right?" And a lot of times, if a business owner doesn't have this information prepared beforehand, what ends up happening is that entrepreneur will say, they'll either say a lot, or they'll say, "Well, I think I need about $20,000, right?" And as soon as a lender says or hears "I think I need" rather than "I know I need," um, usually from the eyes of a lender, you start becoming a little bit more suspicious and saying like, "Oh man, this person doesn't know exactly what they need," right? And as that conversation evolves over time as well, that lender will want to understand like, "Oh, can you tell me a little bit more about your expenses last year? Or how much money did you make last year? Or how much did you spend in rent, right? Or how much of this, how much of that, right?" And it's a lot of this information that if you're not prepared and if you don't know how to answer correctly, then the chances of getting that loan, especially if you're like sitting and like doing a face-to-face with a lender, right, or even an investor, um, it starts getting harder and harder to get to kind of like get the lender's trust to get a loan, right?
Yeah.
That's the best way I can describe that.
Yeah, I think that makes total sense. You want to go in as confident as possible.
Exactly.
All right. So thank you guys for hanging with us. I'm so glad that we've been able to answer so many of your questions. I know we're at time, but I'd love, Luis, if you could keep sharing some of the last pieces of information
Of
you have
course.
with us, just because we've still got a bunch of folks who are hanging with us over time. So let's keep
Of
going.
course. Yeah, yeah. Yeah, like these topics are, you know what, they can be very dense, right? So
Mhm.
just trying to break them as much as possible. I feel like it's a good value for your time, just
Yeah.
because I've noticed that a lot of, especially online guides, it's really difficult to really get a good breakdown as far as why it's important. So I'm trying to do that as best of my abilities for you guys. So last but not least, we have the cash flow statement. So this cash flow statement really kind of lists the flows of cash into and out of your business. So the best way to look at it is to really just consider it as more of your checking account, right? It's all of the money flowing in and out and flowing out of your account. The balance in your checking account is your net cash flow at a specific point in time. So the reason that you really want to start looking at a cash flow, and the easiest way to do this is if you start examining your monthly bank statements for your business every single month. You want to examine all the inflows and all of the outflows of cash, right? Because every single month, money is coming in from sales and money is coming out because you got to pay your staff, you got to pay your utilities, you got to pay your rent, you got to pay for a lot of stuff. But at the end of every single month, you'll have your net cash flow. And that's really kind of your balance at the end of the month. How much money is left at the end, right? And as a business owner, you want to start getting a better understanding of what that movement looks like every single month. So January to February, February to March, even going into the future, is the money going into my bank account, is it increasing over time or is it decreasing over time? If it's decreasing, you want to understand why is it decreasing? And if it's increasing, you also want to understand why am I making more money, right? What a cash flow statement will also do is it'll also kind of highlight the seasonality within your business if you are seasonal as well, because there will be dry times and there will be very successful times as well. So a cash flow really just understands it's how cash is moving in and out of your business, right? And I put a quick example here. This is actually an agricultural business that just kind of highlights all of the money that's going in and out of that business on a quarterly basis and kind of like what the balances look like every month and quarterly and cumulatively as well. So just gonna get a better understanding of how much money is being retained within my business. Because if you see that money is leaving at an expedited rate, as a business owner, you can start taking actions immediately to kind of rectify what that is, right? Maybe your costs are going up and you should adjust your pricing, or it could be something else. So it really helps you understand and adapt early rather than wait a year later and say, oh my goodness, I'm almost out of cash and now I can't pay my employees next month, right? So by analyzing your cash flow, it really helps you and it'll be right here. It helps identify working capital needs by saying, yeah, you know what? I may need to get a loan here because if I don't do it right now, maybe these next 3 months when I'm lean, I might not have enough money to keep my business up and afloat, or I may have to pull more of my own personal money to keep my business alive, right? So it helps you really prepare for financing if you need financing later. It helps predict hard and lean times, as I mentioned earlier, to help manage your business easier as well. It helps diagnose the current state of the business, right? Whether if your cash is increasing, it helps identify if the successfulness of a business, or if your business is failing, right? It helps you really like take a closer look and understand why that may be happening, right? What is pulling out all of my cash, right? Is there something that's increasing in cost, etc.? And finally, it helps increase profitability by identifying excess cash periods. So if you know that you're going to be making a ton of money, let's say during the last 8 months of the year, because that's when you hit all of your sales, it can help you pull that cash and maybe help apply for a loan during that period of time, because it'll be a lot easier to qualify for a loan because your financials look really strong because you have a lot of cash currently in your business, rather than applying when you actually need the money and your cash reserves are low, right? Because remember that as a lender and an investor, it's easier to invest in a business that doesn't need money currently rather than a business that actually needs money right now and they may not have the resources to pay you back, right? So you're less risky as you're applying if you can tell them, hey, look at all this money that I have, and you know what, I need this money to do X, Y, and Z, but if in case anything happens, I have this cash to pay you back, right? Rather than approaching a lender when you're very desperate and the lender says, well, if I give you this money, there may not be an assurance that I get paid back, right? So it really helps you prepare for financing later. So that's why it's very important as well. And here I have a quick example of what a cash summary looks like, or a 12-month cash flow does. So as a business owner, and we'll make sure to get some of these templates out for you guys as well if you guys are interested. You know what? It helps really understand where your money is going on a monthly basis, right? So we have a cash flow template here that really just highlights kind of like all the money that's coming into your accounts and all of the money that's being paid out. And it breaks it down by categories as far as I'm paying this much for advertising, rent, loans, whatever that may be, right? So that really helps you understand on a month-to-month basis, this is where my money is going into every single month, right? To better understand, so if you look at gross wages in this example, you see that from July to August, wages went up by 14,000. Why, right? As a business owner, you really want to understand, why am I paying more in wages now? Am I hiring someone else? Is it because I hired someone temporarily? So it really helps you as a business owner take executive decisions. And as I mentioned earlier in the very beginning, it helps you work on your business rather than constantly being kind of like stuck in your business, just taking care of your day to day, right? And that's really what a cash flow statement really does. So really quick examples, right? So that pretty much sums up our webinar for today. Thank you so much for sticking around. I know we're a little bit over time, but if you guys have any questions, more than happy to take them as well at this period.
Yeah, thank you so much, Louise. I feel like this is such valuable information for everybody. Very practical, and you guys can take these details back and apply them to your business, later today if you want. And so, as we've mentioned before, we're going to be sending the recording of this presentation along with today's worksheet, so you can practice some of these skills, and the slides and some templates for some of these documents with you. Um, We'll be sending those to you later this afternoon, and we will be in touch. Stay tuned for more webinars on topics like this, so we can help you guys succeed for your business. And thank you, Louise, so much for sharing your expertise. It's
My
really been
pleasure.
fantastic. All right, thanks everybody. We'll see you soon.